money management and position sizing. Most professional spread traders would agree that money management is the single most important factor that determines long-term profitability in the financial markets. Money management is essentially a system that will make your capital last and enable you to survive losing streaks. The key to managing risk is to manage the position size of your trades. Position sizing is one of the most important aspects of managing your risk. It helps you to identify the amount of your account balance you are prepared to risk with each spread trade. New traders tend to focus on the outcome of the trade, overlooking the anatomy of risk factors and the tools to manage this risk. In reality, the outcome of trade is uncertain. The question then becomes, how much can I afford to lose on this trade? Once you answer this question, you will either want to adjust your position size or your stop loss. It is more important to adjust your position size than your stop loss, as the stop loss should be based on technical levels. The fixed percentage rule: how much should you risk per trade? A common approach is to risk only 2% of your total capital per trade. Some say that this is too much and others say that it's too little. However, 2% is a good starting point for risk management. If you are having 50% success with your trades, this will allow you to have a run of losses and still have a viable float to continue trading. And at the same time, when profits go up 2%, 5%, 10% or more, and you have leverage working for you, your profits can soon add up. Of course, you could risk a larger percentage, but keep in mind that the larger the risk percentage level, the fewer losses you can sustain before it becomes very difficult to recover. Position sizing, or how to determine your spread betting stake. Once you have established the maximum amount you are willing to risk on a single trade, how do you ensure that any losses don't exceed this stated maximum loss level? One way is to use your stop loss level and then calculate the distance between that stop loss level and your initial entry level. After that, you divide the total amount you are willing to put up at a risk by measuring the gap between the stop loss and your trade entry point. This is best illustrated by an example. The advantage of this trading method is that the amount you risk per trade is automatically adjusted as your trading capital fluctuates. This method, however, requires that you have the discipline to exit the trade as soon as your stop loss level is triggered. Other possible ways to calculate the position size would be to buy or sell a fixed number of stake size per trade, or allowing a fixed pound quantity to each trade, or varying the trade sizes depending on your performance. The fixed pound risk model is good at managing risk, but as opposed to the fixed percentage mode, the amount that you choose to risk per trade will not change in line with changes to your capital.